Greetings and welcome to today's webinar. One of our AggieCon graduate students, Garrett Reed, will present on a number of alternative transition plans and their probability of success. He recently completed this study and will share what he learned with us. Today's presentation will run around 30 minutes. If you have any questions, please ask them in the chat box in the lower right corner and Garrett will answer them for you. For additional information on farm transition planning, visit the OSU Farm Transitions website, and I will paste this address into the chat box. Garrett, I will turn it over to you now.
All right, thank you, Brent. Like you said, my name is Garrett Reed, and this was my thesis presentation and defense that I recently presented last week, and was happy that I passed. So hopefully you'll get some good information out of this presentation. So the title of my thesis, like you can see, is Assessing the Rate of Success of Alternative Farm Transition Strategies. I would like to thank my committee members. They were very influential in this process, Dr. Shannon Farrell, Dr. Rodney Jones, and Dr. Eric DeVeest. And then also, J.C. Hobbs, our Extension Tax Specialist here in the Ag Econ Department, helped with a lot of the tax calculations that we encountered along the way, as well as developing some of these alternative strategies. Dr. John Michael Riley, one of the Ag Econ professors here in our department, also helped with this process. Mr. Mike Schrammel of Oklahoma Ag Credit, Joe Kreger and Luke Worth of Northwestern Mutual, and Jimmy Harmon and Lauren Schneithman of Oklahoma Farm Bureau. These people provided us some industry perspectives and gave us some real-world application on how they would handle certain situations. So what is farm transition planning? Well, it's the process of transferring farm assets ownership and management to the next generation of farm operators. Now, this encompasses a few different things. Estate planning, so what we typically think of attorneys dealing with, such as wills, trust, estates, etc. Retirement planning for the preceding generation, so we want to ensure that mom and dad live a comfortable life in their retirement years, and we want to make sure we properly plan for that. And also farm business management. So why is this important? Well, research from the Family Business Institute indicates that only around 30% of family-owned businesses transfer from the first generation to the second generation. That statistic decreases to 12% when transferring from the second to the third generation, and sadly only 3% transfer from the third to the fourth generation. Now, Kirkpatrick in 2013 said that well-documented goals of many farmers consist of long-term viability of the farm, financial security for the founding generation, and keeping the farm within the family. Now, if we look at those goals and the statistics up above, I'd say that many farmers aren't meeting these goals that they have documented. Especially financial security for the founding generation, like I mentioned a second ago, that is a huge consideration in developing a farm transition plan to ensure that mom and dad maintain that financial security through their retirement years. So in 2009, Hatchfield surveyed Minnesota farmers through a series of extension workshops. Of the 524 workshop attendees, almost 300 completed their surveys. They found that nearly 60% did not have an up-to-date estate plan and that nearly 90% did not have an up-to-date farm transfer plan. Now, they sent out another survey a few months after these extension workshops, and the participants were asked to list the top 5 barriers that they encountered in trying to develop an estate plan or a farm transfer plan. And the top 5 most common barriers that people encountered were finding time to complete the process. Many farm operators have a lot of irons in the fire, and this was just one more thing to add to their plate. Many of them had difficulty developing family and business goals, and the difficulty that came from developing those goals, I'm sure, led into a lack of family consensus and disagreements for our third barrier. The fourth thing that they found was difficulty finding the right professionals, so the right attorneys, the right financial planners, the right tax professionals. And then lastly, parents not ready to give up control of the farm. So oftentimes we'll see farmers that delay retirement for a variety of reasons, but this was one of the top 5 reasons and barriers and obstacles that many farm families encountered when trying to develop this farm transfer plan. So Spafford in 2006 that farm transitions fail for three main reasons. One, inadequate estate planning, which we can see from the statistics up above previously that many farmers don't have an estate plan. Insufficient capitalization, meaning the farm doesn't generate sufficient cash flow to fund a particular farm transition strategy. And then failure to prepare the next generation properly, meaning all of that institutional knowledge that is gained, that the dad, the farm operator, may have gained over the years. That information needs to be passed down to the farm heir as well, not just the whole farm itself. Many farmers can inherit a farm that is profits well, that is in sound financial condition, but if they've never been a part of that decision-making process, they may not know just exactly how to properly run that farm business. So the purpose of this research is to develop a model that will allow researchers and extension educators to simulate alternative farm transition strategies in an effort to increase the success rate of farm asset transfers. And we'll show you how we did that here in just a few minutes. So I had three main objectives for this research. The first was to determine the ability of the farm's cash flow to support a given alternative farm transition strategy over a 20-year planning horizon. Now, the five vehicles we use to operate these different transition strategies consist of a commercial loan, a seller financing or buy-sell agreement, a sinking fund investment, a second-to-die whole life insurance policy, and a lifetime farm business transfer. And specifically, I'll get into how we utilized each one of these vehicles once I start talking about the alternative strategies. Our second objective was to determine the probability of a successful farm transition using the aforementioned alternative strategies, subject to time, equity, and cash flow constraints. And then thirdly, we wanted to provide educational examples and tools to support farm transition research and educational efforts. So how did we go about doing this? Well, first, we developed a representative Oklahoma farm. We wanted the results to be applicable to a broad range of farm owners. Now, this farm doesn't look like every operation in Oklahoma, but again, we wanted to develop a farm that would hopefully reach a broad range of farm owners. So we developed a commercially viable 1 FTE farm that consists of mom, dad, farm heir, and off-farm heir. And we largely used data from the Kansas Farm Management Association and their farm financial ratios to budget out the size of this farm. So the representative farm generates on average $100,000 in net farm income. The reason we chose $100,000 is because of family living expense being approximately $70,000. So we knew that if there was any chance to finance one of these alternative strategies, we needed to have some funds left over after family living withdrawals. I included an off-farm income portion of $44,000, and this is simply the per capita income for the state of Oklahoma. Our value of farm production of $660,000 was determined by dividing our net farm income of $100,000 by approximately 15% to reach this $660,000. Using an asset turnover ratio of 20%, we reached the total farm assets to be $3.3 million. Using a debt to asset ratio of 20% as well, we determined that this farm has around $660,000 in debt. Half of the income is generated from cattle production, half of the income is generated from crop production, and this farm owns a little over 1,100 acres and leases an additional 2,500 acres. So here is the farm's balance sheet with those various numbers that I just went over. Now, if you'll notice in the breeding livestock value, that number was calculated based off of how many calves we needed to sell each year in order to reach 50% of our income to be generated from cattle production. So if you have any questions about the various calculations we took to determine our breeding livestock value, I would entertain them as well. But that number was calculated based off of how many cattle we needed. The equipment value was not calculated. That was an assumption that we plugged into this model farm simply based off of the Kansas Farm Management Association data. Farms of this size, generally speaking, had around $500,000 in equipment. The building's value was the same as the equipment in that we didn't calculate that number. That number was pulled, again, as an assumption of looking at the Kansas Farm Management Association data. Now, our total land value was determined by taking the total assets, which we found earlier, and subtracting breeding livestock, equipment, and buildings. That reached our total land value. Dividing that by $2,000 an acre reached the number of owned acres that I mentioned earlier. Again, I realize that land varies across or land values vary across the state of Oklahoma. Pasture acres versus crop acres also vary, but an assumption of $2,000 was made for this representative farm. And on the right side, you can see the long-term debt and the owner's equity as well. So the representative farm family all live and die on the averages, meaning mom and dad are 58 years old at the start of this transition, which is the average age of the principal operator according to the 2012 Census of Ag. Now, I realize the 2017 Census of Ag just came out, but we went off of 2012. We assume that mom passes away at 81, which is the average age of female mortality, and that dad passes away at 76, the average age of male mortality. At the start of the transition, farm heir is 32 years old and off-farm heir is 30 years old. Now, we determine these ages based off of when parents have, on average, their first child and when parents have their second child, which is 26 and 28 respectively. And these ages will play into how long our planning horizon is for these alternative strategies. So here's a list of the 5 strategies that I'll be going over, and just to give you a brief overview: a split down the middle, grow to equal, estate balancing, a sweat equity recognition, discount, and then a lifetime farm business transfer. But I'll specifically discuss which each one of these alternative strategies consist of. So strategy 1, split down the middle. Undivided half interest are given to both heirs. Now, this is most common whenever there is no plan in place, and we refer to intestate succession laws, or when mom and dad say, I will let you kids sort it out, and they give undivided half interest to both heirs. Now, we assume that off-farm heir demands a buyout because more often than not, the off-farm heir wants their inheritance in cash, and the farm heir wants to keep the farm together at its current level of operation. We can do this with 2 options, a commercial loan and seller financing. So for strategy 1A, a commercial loan, after discussing with agricultural lenders on term lengths and interest rates, we determined that 3 separate notes would be needed for this operation for cattle, equipment, and real estate. The cattle and the equipment are 5-year notes at 5.75% interest, and the real estate is at 20 years for 6.5% interest. Now, you can see the annual payments for each one of these notes, but it is worth noting that in the first 5 years, you're actually paying on all 3 of these notes, which ends up being around $170,000 the first 5 years. Now, keep in mind, the farm only generates $100,000 in net farm income, so this is extremely challenging. Also, this assumes that farm heir is able to make a 20% down payment up front, which would be $330,000. Again, that's going to be very challenging for farm heir to come up with those funds if they don't already have them. So strategy 1B, with the seller financing, we decided to finance this option with the off-farm heir and combine all 3 notes into one. So a 20-year note at a little over 3% interest, which is the applicable federal rate. It's the lowest interest rate you can loan money to a family member and not be considered a gift. That would require an annual payment of $89,000 a year. Still pretty challenging. So strategy 2, grow to equal. We assume that farm heir inherits all of the farm assets, and then mom and dad create a financial asset to equal the value of the farm asset base. And we can do this with 2 options, a sinking investment fund or a second to die whole life insurance policy. So with our total asset value of $3.3 million, using an after-tax real rate of return of about 4.5% and a 20-year pay period, we determine the annual payment is $104,000 a year. Again, this is extremely challenging when the farm only nets $100,000 a year. With strategy 2B, this time we're using life insurance. So with the same $3.3 million asset value, we used a proxy rate of return of 9%. Now, I gathered various life insurance quotes for varying ages, varying amounts from a few different companies. After I brought in all of those different insurance quotes, I calculated what rate of return would be needed in order to yield this amount. So, after calculating these various rates of return, they varied from 6% all the way up to 29%, again, based off of the amounts, based off of how many years we were paying in. And the average was 11%, but the modal rate of return was 9%. So that's the proxy rate of return I'm going to be using today for life insurance. Obviously, I'm not a life insurance salesman. I can't quote life insurance to someone, but this is a good estimation of what a life insurance policy would cost for mom and dad that are 58, no pre-existing conditions, that are in good health, that are going to be paying into this life insurance policy. So for 20 years, the annual premium would be $64,000. Strategy 3, estate balancing. So the farm operating assets and the farmland are placed in separate entities respectively. Farm heir inherits the operating entity, which consists of the cattle and equipment. Farm heir and off-farm heir receive equal interests in the land entity. The operating entity then pays fair market value rents to the land entity. That land entity then distributes the income to farm heir and off-farm heir based off of their proportion of ownership. So in a way, farm heir is subsidizing his rental payment. He pays in a full rental payment, but then gets half of it back because he is a part owner of the land entity. Mom and dad then create a financial asset to equal the value of the operating entity. So this is where the balancing comes in. Off-farm heir then inherits this financial asset, again using an investment fund or a life insurance policy as the vehicle to do so. So with an operating entity value of a little over $900,000 with the same real rate of return of about 4.5% over 20 years requires an annual payment of $28,000 a year. Using life insurance as a vehicle to reach that same amount at the proxy rate of return would require an annual premium of about $17,000 a year. Each time you're going to see that the life insurance quote and premium is going to be cheaper than the sinking fund investment. And the reason why is not simply just because of the proxy rate of return that I'm using, but because of the tax drag associated with the sinking fund investment versus the life insurance. So strategy 4, sweat equity recognition / discount. So this is similar to strategy 3 in that the farm operating assets and farmland are placed in separate entities respectively. Farm heir then inherits the operating entity like before. Farm heir and off-farm heir receive equal interest in the land entity. The operating entity then pays fair market value rents to the land entity, which that income is then distributed back to farm heir and off-farm heir like before. Except this time, mom and dad create a financial asset to equal 1/2 the value of the operating entity. This is the financial asset that off-farm heir receives as their inheritance. We did this because we wanted to recognize farm heir's contribution to grow farm assets. All the work that he's been putting in, all of the labor, the management, the capital that he may have put into this farm over the years, this is the recognition that we are giving to him. Off-farm heir is receiving half of that value, which is still, in the life insurance case, is going to be tax-free, it's debt-free, there's no strings attached to the money. So again, we can do this with two options, a sinking investment fund or the life insurance policy. Half of the operating entity value is about $450,000 at the same 4.5% rate of return for 20 years requires an annual payment of $14,000. Using life insurance as the vehicle to reach that same amount at the proxy rate of return would require an annual premium of almost $9,000. So strategy 5, the lifetime farm business transfer. Now this strategy, it doesn't look like many of the other strategies that I've covered up until this point. The farm operating assets and farmland are placed in separate entities respectively like before, except this time farm heir receives an annual salary of $42,000 a year. Farm heir then turns around and purchases shares of the operating entity each year. With each portion and each share that farm heir is buying of the operating entity, they then receive a larger portion of the farm income as well. In years when the farm heir has insufficient funds to purchase a full share, mom and dad gift them the difference. So at the end of the transfer, farm heir has bought the operating entity from mom and dad. Yes, there are times whenever his income level may not be able to make a full payment, but mom and dad have gifted him that difference in order to purchase a full share of the farm for that particular year. So at the end of the transfer, the farm heir and off-farm heir receive equal interest in the land entity, like before. The operating entity, which is now owned by farm heir, pays fair market value rents to the land entity like before, and that entity distributes the income to farm heir and off-farm heir. Now, any excess funds that mom and dad may have left, anything that they have in their savings account at the end of this transition, after they pass, would then be split between farm heir and off-farm heir, net any gifts that farm heir received over the years to help fund this transition. So with the operating entity value, again, of around $900,000, with a 20-year planning horizon, would require a 5% annual purchase. So the annual entity payment from farm heir would be $45,439. Now, mom and dad's cost is the annual gift to farm heir, which is variable. So it's the $45,000 minus whatever farm heir can pay. Now, one thing we saw here with this model is in the first few years, mom and dad are having to gift more to farm heir to make that full payment. But as farm heir continually buys more of the farm and acquires more shares, they then start receiving larger income distributions. Therefore, in the later years, they are not having to receive gifts from mom and dad in order to fund this transition. And mom and dad are still receiving a stream of cash flow payments from farm heir in their retirement years from the purchase of this entity. So for my thesis, the conceptual framework was to maximize the probability of our net cash flow of these set of strategies to be greater than zero. I'm not going to go through every one of these equations, but the main one that I want to focus on is equation number 7, 6 and 7, where we reach the cash flow of the farm and then our net cash flow after we take out the alternative strategies cash flow demand. So those are the main two that I'm going to be focusing on. But again, you can follow through my calculations and how I determined net cash flow. So how did we determine if a strategy was successful or not? Well, again, after talking to a couple different agricultural and commercial lenders, and looking at some of the farm and ranch stress tests and farm financial ratios, we decided that if the debt to asset ratio ever reached 60%, that particular iteration was going to be a failure. Our second criteria was if the farm ever incurred 3 consecutive years of unpaid operating debt, that would also be a failure. So that's one thing our model assumes, that if there are years when mom and dad are short to fund this alternative strategies cash flow demand, they can use their operating line of credit to cover that difference. Now, this assumes that you have a lender that's comfortable with doing this, that will allow you to use your operating line of credit to fund this particular strategy. Ideally, lenders want to see their operating debt paid off at the end of each year. But we decided that 3 consecutive years of unpaid operating debt is a failure. That plan will not work. The third criteria is if the farm ever incurs any operating debt. Now, you may think that sounds redundant, but we are treating these criteria as if they are independent. And so each strategy will have a probability of success based off of each one of these criteria. Some farm owners may want to finance a farm transition strategy and not incur any additional debt, or they may have a lender that won't allow them to use their operating line of credit for a particular strategy like this. So we wanted one of our criteria to be not incurring any operating debt whatsoever. Now, criteria 4 is only for scenario 5, and that is if the cash reserves of mom and dad are ever less than 0. The cash reserves are what they use to pay FarmAir that gift in order for them to purchase an entity share. And so if mom and dad don't have enough money that particular year to help fund that entity purchase, then we consider that iteration a failure. So I gathered net farm income data from the Kansas Farm Management Association from 2005 to 2017, then adjusted that to real dollars using a CPI index, and then calculated the coefficient of variation, which is essentially the variability in farm income. Now, using our farm's average income of $100,000 a year, net farm income, determine our standard deviation of $41,000. I then use this mean and standard deviation to do a Monte Carlo simulation, given the farm's mean and standard deviation, which this determines a normally distributed random draw in farm income each year. And this just applies variability and risk in farm income because we don't know what it's going to be like. So one 20-year planning horizon is one iteration. Over the 20 years, each year is a random draw in farm income. So each strategy is then imposed on the model farm and then simulated 500 times. So with each failure within a 20-year iteration is reported by a 1, subject to the different criteria that I just went over. So by adding up the number of failures, dividing by the total number of iterations, that gives us our probability of failure. Subtracting that number for 1 gives the probability of success for that particular strategy based on that particular criteria. So what did we find? So here's a table outlining the strategies on the left and then the 4 criteria and their corresponding probabilities of success. Now, I'm not going to go over every one of these numbers right here in the table for you because I'll dig into each one of these strategies individually, but the one thing I do want you to look at is in between strategy 2B and 3A, we definitely see a shift in the probabilities of success, and we'll talk about why we see that shift here in just a second. So with strategy 1A, the commercial loan, as you can see, very rarely is this strategy ever going to be possible. Based on our debt to asset ratio criteria, 1% of the time this strategy was successful. However, when looking at our operating debt criteria, there is a 0% chance of success. Again, we really modeled this strategy to show farm owners how not to transfer a farm. This is what many people do, but if you are truly concerned about the longevity of the farm business and keeping the asset base together, this maybe isn't the right option to do that. So I did conduct a sensitivity analysis and ran the model using net farm income from $60,000 all the way up to $140,000 on average to see how those probabilities of success would change. As you can see in the graph, the debt to asset ratio criteria does increase as we increase our income levels, but it doesn't help the operating debt criteria. So strategy 1B, our seller financing, where we finance this with the off-farm air, the debt to asset ratio actually never reached the 0.6 threshold. So I didn't end up graphing it because it would just have been a straight line. Based off of incurring 3 years of unpaid operating debt, 4% of the time this strategy would work. However, you have to incur some level of debt in order to finance this particular strategy. You can see that the probability of success does increase in terms of the 3 consecutive years of unpaid operating debt as your income levels increase, but again, this is still an extremely challenging scenario and strategy. So strategy 2A with our sinking investment fund, where essentially we are doubling the farm's asset base over a 20-year planning horizon. The debt to asset ratio, again, never reached the 0.6 threshold, so I didn't graph it. Based off of the operating debt, there is a 0% chance of being able to finance this strategy. It's simply too challenging, and obviously by the straight lines at the graph you can see that, and I'm really not going to dive into this too much. When using life insurance as the vehicle to reach this same amount, The statistics are slightly better at 1%. As your income levels increased, they actually did increase the probability of success quite a bit, but again, for a representative farm that generates close to $100,000, this strategy is simply not advisable. And again, mom and dad are trying to double their asset base by giving the farm to the farm heir and creating this financial asset equal to the value of the farm to give to the off-farm heir. Now, strategy 3 again is where we start to see the shift in statistics. Looking at criteria 2, 96% of the time this farm did not have to incur 3 consecutive years of unpaid operating debt to fund this strategy. Pretty high success rate, and 89% of the time did not have to incur any additional debt at all to fund this strategy. Once I increased the income level out to $140,000, both of these criteria had a 100% probability of success. And you can see, even after $100,000, they're getting dangerously close to 100% success. Using life insurance as the vehicle to get there, this actually would work 100% of the time based off of the simulation, based off of this model farm, that the farm would not incur 3 consecutive years of unpaid operating debt, and that 97% of the time this farm wouldn't incur any additional debt. When increasing the income levels up to $130,000 a year on average, that both criteria are met 100% of the time. Now, again, with strategy 4 is like strategy 3, except we are giving the off-farm heir half of the value of the operating entity. Again, based off of criteria 2, this works for this model farm 100% of the time. 97% of the time, you don't have to incur any operating debt to fund this particular strategy. And increasing the income levels to, on average, $120,000 a year, both criteria are met 100% of the time. Using life insurance as the vehicle to reach that same amount, again, the statistics are dangerously close. 100% of the time, the farm did not have to incur 3 years of unpaid operating debt, 3 consecutive years of unpaid operating debt, and then 99% of the time the farm didn't incur any debt to fund this strategy. Again, increasing the income levels up to $120,000 a year on average, both criteria are met 100% of the time. Now, strategy 5 with our lifetime farm business transfer, 99% of the time, mom and dad's cash reserves did not fall below zero. Now, this is really important to note because the cash reserves, again, are what mom and dad have in order to gift to farm heir the difference they are short in order to make a full entity payment. So this strategy nearly worked every iteration. Whenever we increased the net farm income to $110,000 a year on average, that criteria was met 100% of the time, again, for this model farm and for this simulation. So what does all this tell us? Well, strategy 1 is simply not an advisable solution, no matter the variation, if we're approaching commercial lender or we're doing seller financing. And again, simulated this for a couple reasons. This is the modal strategy employed by farm families whenever they want to treat their heirs equally. And hey, we'll let you kids sort it out. Here you guys go. You can split up the farm as you wish. And we also did this to show people how not to transfer the farm, like I mentioned earlier. It's pretty simple math. When the annual debt payments are more than the annual income of the farm, it's destined for failure. And such a large portion of the farm's asset base consists of land. For USDA, I think around a little over 80% of the average farm's balance sheet consists of real estate. This one was slightly less than that, but again, you can see that including the repurchase of land in this transition strategy is extremely challenging because land is illiquid, relatively illiquid, and generates low cash returns. So strategy 2, where we're trying to grow a financial asset to equal the value of the farm, was just as challenging as strategy 1. Neither variation, whether using life insurance or the investment fund, are advisable solutions. This is a very aggressive investment option and is a huge financial burden for mom and dad. And again, you're trying to double the asset base over 20 years, which causes this challenge. And again, creating a financial asset that incorporates that land value poses the challenge for this strategy. And perhaps if mom and dad are that set on doing some sort of investment option, maybe they could possibly invest in growing the farm asset base and making it more profitable instead of this financial asset. With strategy 3, estate balancing, taking an approach that does not require the repurchase of land allows for a lower, more attainable cost or cash flow demand. Now, this does not take into account farm heirs' contributions to grow the farm asset base over the years, but it does have a higher probability of success than the previous one in strategies 1 and 2 that I just covered. For those parents who equate equal as being the same as equitable, this may be their preferred strategy if it aligns with their family and business goals. Now, strategy 4 is a recognition of farm heirs' contribution to the farm, and the distinction between equal and equitable is explicitly made by the amount of inheritance that both heirs receive. Again, farm heir is receiving the operating entity, off-farm heir is receiving half of the value of the operating entity. So farm heirs' inheritance may be discounted, but they are still receiving an annual portion of the rental payments because they are part owner in the land entity. So this kind of illustrates the cost reductions realized by not requiring, again, the repurchase of a portion of the land assets from the off-farm heir, and this does lower the effective cost of farm heir to pay access for the farm land because, in a way, they are subsidizing their rental payment. Again, strategy 5, our lifetime farm business transfer. Mom and dad are slowly removing themselves from the operation because the farm heir is purchasing a share or a portion of the farm each year. Now, this allows mom and dad to maintain a comfortable life and maintain financial security and a stream of income during their retirement years because farm heir is paying them this annual entity payment. This does allow for a gradual shift of management, institutional knowledge, and decision making while all parties are alive. The other strategies have been at-death strategies. This one here is a true transition over the lifetime of both parties. Again, off-farm heir receives a stream of payments from the land entity and a portion of the cash reserves. And farm heir has earned the rights to the operating entity because they have purchased it. So, time is definitely on your side if you start this transition process early. Extended planning horizons would allow for strategies with a lower cash flow demand if you were to start earlier. However, before that plan can be initiated, families need agreed upon goals to work towards. We don't need conflicting goals or conflicting ideas. They need to have one idea that they need to work towards in order to make this transition work. I realize that the representative farm does not look like every farm in Oklahoma in terms of its size, its balance sheet, its family structure, but hopefully this would be applicable to a broad range of farm owners. And we developed this for educational and extension purposes with the hope of seeing a higher percentage of farm owners not only recognize the need to develop a farm transition plan, but also take action by actually implementing this plan. Now, my model does have some limitations. If any of the term links, interest rates, rates of return, health characteristics, age, years of planning horizon change, so do the results and the probability of success. If the farm that I use to simulate this model changes, obviously the results would change. Some farm owners are more profitable, some are not. That's why I did the sensitivity analysis to show, hey, maybe you only generate on average $80,000 a year. What would that look like for you? Same thing with a farm owner who generates on average $120,000 in net farm income a year. Within Oklahoma, lots of farms receive royalty payments from oil and gas or wind energy. I didn't include any other sources of off-farm income other than the assumption that this farm owner has a spouse who works off of the farm, bringing in approximately $44,000 a year as off-farm income. In reality, there are other sources of off-farm income that could be taken into account that again would change these statistics. And this model assumes the time of death, but we all know that the time of death is not known. But these limitations do provide more opportunities for future research and development of this model. Future versions of this model, I would like to vary the number of heirs that are associated with the farm. Make the time of death random because, again, we assumed based on the average age of mortality when these people are passing away, but in reality, we don't know that. I assumed I assumed constant annual rate of returns, but in reality, that's not the case. So I would like to include some risk associated with those annual rates of returns for our investment portfolios. Create more user-defined inputs. So like I mentioned earlier, with the off-farm income, there are other sources of income that many farm owners may have, or more cash they have on hand. They may be able to fund one of these particular strategies. What happens when there's more than one farm heir? Well, I would think that the transition strategy would look quite different. We would actually probably be needing to grow that farm asset base and move it to a 2 FTE farm instead of a 1 FTE. What if there are no heirs? Well, obviously, mom and dad could liquidate their asset base and get on a cruise ship and travel around the world and enjoy their retirement years. But right now, with so many young people wanting to get into production agriculture that maybe didn't come from a farm family that's well established, there may be an opportunity here for a mom and dad, or for a couple who don't have any farm heirs, that maybe they want to somehow create a transition plan with someone that's not a family member. Maybe that looks like strategy 5 of the lifetime farm business transfer, where there can possibly be a relationship developed there, and some sort of buyout of this couple's farm. Again, future research could possibly come from that. And then other strategies. This is simply a set of strategies that we analyzed, but in reality, there are more farm transition strategies that are out there. And with that, that concludes my presentation. So I would open it up for questions. I don't see any in the chat box. And
Thank you, Garrett. We appreciate you taking time out of your schedule to join us for this webinar, and please take a moment to fill out this short survey, which will help us evaluate our efforts, and the link is in the chat box in the lower right corner. And we will have another webinar in May, and so thank you for joining us, and we'll see you then.